Welcome to Alternative Realities, a podcast about the people, strategies, and stories driving the world of alternative investments. I'm Aaron Mulvihill, and my guest today is Brad Demong, Co-Chief Investment Officer of the Global Special Situations Group at JP Morgan Asset Management. Many investors, and particularly investors new to the asset class, equate private credit with direct lending. But private credit is a much larger space than just direct lending. And this year, with concerns over software exposures and rising credit stress in direct lending, we've seen other strategies gain interest. In particular, distressed and special situation strategies, a large and established segment of the market, are gaining in popularity. On today's episode, we will discuss why interest in distressed and special situations credit strategies has risen, how the private credit market has repriced from dislocations that occurred earlier this year, and how the current private equity landscape is providing opportunities for distressed and special situations investors. Brad, thanks for coming on Alternative Realities.
Thanks for having me today.
So but before we start, I'd love to hear some background on yourself and your career. You've had a very interesting career path.
Yeah, I think actually I'm pretty unique in this day and age, which is I've worked for one firm, which is JP Morgan, but had several different jobs within JP Morgan. So I started right after I graduated from college or university, depending on who's the listener. But and when I say right after, 14 days, and then worked within JP Morgan's investment bank for quite some time. And then in the spring of 2016, my business partner and I made a transition, and now I work within the asset management function of JP Morgan. I think what's been pretty unique about that is the experience of getting to know the organization. I also worked in London, and that gave me the opportunity to explore European opportunities and the different ways of doing business. And then now today I live in New York, and my business partner, Leander, lives in London. And that keeps a connection for me on a global basis, which is also another aspect that's really nice of the larger JP Morgan platform, is having that kind of global reach and breadth.
Okay. And so when many investors think about private credit, they go first to direct lending, which of course is a very large sector, but not the only part of the private credit space. And that kind of ignores $1 trillion of capital out there in special situations, in distressed lending. So can you give our audience a sense of what is distressed lending, what is special situations, and maybe some examples of what that type of lending looks like?
Yeah, I think that's a good place to start, is maybe just framing the asset class, as you said. And I think for some people, private credit is synonymous with direct lending. And that has been one of the fastest growing segments coming out of the GFC, the global financial crisis. And so what you saw was as regular way banks largely retreated from lending, that was filled by institutional investors in the form of private credit. And so private credit kind of gets the headline through the direct lending product. However, as you correctly said, there's more than $1 trillion of capital in other private credit asset classes. And what's interesting is that I think special situations and distressed credit has largely been described as one of the other through the cycle investing products, more so on the special sits than distressed. But during periods of uncertainty, you see a significant pickup in interest in those two products, really because I think clients want to have something that's more focused on being able to take advantage of market dislocations and being able to participate. And so what you see today is that actually comprehensively, kind of the rest of private debt is about 46% of the private credit universe. And within special situations, that's been one of the largest growers more recently. And you tend to see people allocating to that portion of private credit when there's uncertainty. And I would argue today there's a certain degree of uncertainty with regard to geopolitical backdrop, credit quality. And so it's not surprising that you are bringing that up as something to think about, which is what are you doing in your private credit portfolio away from just the traditional direct lending asset class, but also some interest in special sits.
And there's hardly been a period of more uncertainty, I would argue, than today. And private credit particularly has been in headlines for some of the wrong reasons, right? We've had concerns around concentration in software, with AI potentially being disruptive to that. There's been redemptions from the private credit funds focusing on private wealth clients. How has that affected your space? Is that creating opportunities? What do you make of kind of the recent challenges in that direct lending segment?
Yeah, so I think in many respects, we're at an interesting period of time, right? You correctly flag a number of different issues, and maybe we just start with sort of some of the headlines around what's going on in the BDC landscape. And
yeah,
I think
that's a good place to start.
That's probably, something that most readers or listeners will see in the headlines every day, which is why are BDCs attracting a lot of attention? I think BDCs have been really one of the favored access vehicles for the retail investor, somebody that is not in a position to write huge checks and to participate in the private credit market. Those vehicles obviously are trying to cope with the fact that investors want to effectively have liquidity against an asset base that may not be that liquid. And we know historically that it's always been a struggle of the financial industry as to how do we match the right asset base with the assets that are in the underlying fund with the investor base. And so interestingly, you're seeing a lot of investors currently, and have been for the last several quarters, requesting liquidity, and therefore you hear about redemptions. And that means that people are effectively asking to take their capital out of those funds, but they've been designed to effectively only provide redemption requests of roughly 5%, I think, generically. And we've seen anywhere from high single digits to up to 40% redemptions in any given quarter. And so that produces a situation where some of those BDCs or business development companies are having to sell assets into the market really to try to meet that. And so that's the first level of kind of grabbing the headlines, which is just as a very simplistic statement, which is people want to have their money back and maybe thinking about other places they want to put their money. And why is that? Well, I think there's been a lot of headlines, as you say. Software has been a huge concentration issue for a lot of the private credit lenders, generally speaking, and it doesn't necessarily apply to everyone, but I think generically most people would say that direct lending and some of the underlying loans in these BDCs have been a reflection of where private equity deal flow has been. And so a lot of those deals and transactions, not surprisingly given the backdrop of the economy, has been focused on software companies. And so some of these BDCs are having exposures of pretty close to 40% of their asset base in software companies, which are definitely ripe for disruption. I mean, clearly the question is
the SaaS apocalypse first on public equity markets, and then it sort of transitioned to private credit and private equity with the realization that there's a very large exposure also to software in these sectors.
Correct. And I think we'll come back to what our view is on software. I'll circle back to that, but just keeping things sort of the thread together of your original question. As a special situations manager, it's always interesting to see whether or not some of these managers who are under pressure to return liquidity to their investor base, whether they're going to be able to sell the assets that they can or the assets that they want to. And so, for us, we're seeing the opportunity to potentially buy really attractive assets simply because some of these other investors are facing a situation where they have to sell their good assets to be able to meet those redemption requests. And for us, we always get excited about the opportunity of buying good assets from distressed sellers, not necessarily having to buy distressed assets, but actually buying good assets from distressed sellers. And I think that's one of the phenomenon that you may see and is actually an unintended consequence of concerns around software, where liquidity is actually the underlying problem.
And if we dig a little bit deeper into that software question, what is your view on software? So you're maybe taking exposure of some of these companies that are being divested, or some of the loans that are being taken off those books. How do you view the software sector and that story playing out?
I'll be honest. I think the software sector is a challenge, mostly because if you look at some of the well, let's just step back. Generally speaking, most people who are lending money or even buying into on a secondary basis into loans will be thinking about an asset class that traditionally has expected to recover 60 to 80 cents on the dollar. And I think that's probably where people are most off. And certainly what we're seeing is that recovery rates for some of the loans that are being done today, I mean, generically speaking, recovery rates in the broadly syndicated loan markets are in the 30s. And a lot of the outcomes for software companies are likely to be single digits or even zero. And so that's one of the things that I think is difficult, is that there's clearly going to be a need for software, but you don't know which ones are going to be completely disintermediated by some of the advances in technology through AI and, the LLM progression that we're seeing from a coding perspective. But it's certainly an area where, depending on which statistics you take, anywhere from 20 to 40% of exposures for some of these managers are in the software space. Not all of those are likely to be winners. And if we're seeing very low recovery rates, the impact on portfolios could be pretty significant. I think I would flag that when we look at kind of generically the market and we think about what brings some of this to a head, it's usually going to be liquidity issues. And I think in 2027, it's a fairly low percentage of the leveraged loan market and high yield bond market that has software maturities. But in 2028 and 2029, you're looking at fairly significant step up in maturities. And that's when I think some of this will play out. And if you just think about the progression and speed of progression from a technology perspective, AI and some of these models, I think, are likely to probably have made huge advancements over the next 12 months. And that's where we'll start to see who's the winner and who are the losers associated with it. There's also, sorry, Aaron, to digress it, there's multiple different ways to play that, which is potentially we can look at some of these situations as they run off. It may not be a long-term survivor, but there may be cash flows, and we buy things on a net present value basis as well against the recovery rate of those cash flows.
Right, because today still, most software companies are generating cash. They've got a very good kind of SaaS business model. It's more of kind of a tomorrow question of how or if they get disrupted.
Yeah, and I think most people actually point to that when that topic comes up. I would just say, I've been doing this for a long time, and if we think about the directories business, when I was much younger in my career, the some of you may not actually even know what that is, but once upon a time there was a Yellow Pages book that most households had that had advertisements and industry services that you could get, and it was sort of the Bible of business advertisement. And those were very cash flow generative businesses that were the darling of private equity. And a lot of the private equity firms were chasing those businesses because it had a high cash conversion rate, right? You'd take your advertising dollars in, you'd print the book, you'd ship them out, and you'd bank the money associated with that, and you'd start the sales cycle all over again next year. What a great business, reoccurring cash flow.
Yeah, sounds great. Sign me up.
Except for something called Google and some of the other search engines came along, and overnight those businesses went from trading at 12 to 15 times EBITDA multiples to trading at 12 to 15 cents on the dollar, which was really a reflection of the runoff of the cash flow associated with that. And so, absolutely, is that industry ripe for disruption? For sure. I think for us, we tend to focus on companies that have a more tangible asset base. Mm-hmm. And so I think that's probably going to be one of the reasons that we will be slow to participate in those businesses. I think taking a long-term view against the long-term cash flow is more difficult. Maybe when the price adjustments are more significant, we'll see that will be the case. And we haven't really seen the significant markdowns. You're seeing the broadly syndicated loan market talking about 15 to 20 point discounts against par, so trading at sort of 80 to 90 cents on the dollar. Private credit has been much slower to adjust. We'll see if that's the case. And the dispersion of marks within different managers is significant, which tells you a lot of people are still trying to figure out what the impact will be.
Right. A lot of unknowns. It's going to be fascinating to see how this plays out. So zooming out here for a minute, I'd like to talk about the macro picture and interest rates. We have a new chair in the Federal Reserve. When we came into the year, we were looking at potentially interest rate cuts. Now that's potentially off the table, given we've got very persistent inflation. The economy seems to be still growing at a pretty solid pace. How do you think this higher rate environment and higher inflation affects borrowers today, and what are the implications for investing in private credit and the special situations in distressed sector specifically?
Yeah. So, I mean, as a starting point for the discussion, I'm not an economist. I'm not necessarily going to be the one that's going to give you the best guide. We do have at JP Morgan Guide to Markets. We also have Guide to Alternatives. We've got different ways that you can sort of pick your best data point associated with it. I think the impact of higher for longer, if that's where we're going, is on the back of a pretty significant change in the interest rate environment that we saw really coming out of 2021, 2022. And I think for us, as we look at the opportunity set in front of us, we sort of break it into different buckets. Some are going to be driven by what we're seeing with interest rates. And I think private equity portfolio companies is one of the spaces that I think is going to be most impacted. And, I think we were going to get onto the topic a little bit later on, but I think I want to bring it forward and just say, with an interest rate environment where it's going to be higher for longer, a lot of these capital structures were really not designed to have the interest portion of cash flow being towards servicing debt loads. And
right, it came as quite of a surprise if you're sitting down making an LBO model in 2021.
Yeah,
you weren't necessarily factoring in rates at today's level 6 years later.
And we're seeing that with the opportunity set for us, and that's related to your question, which is, there's 3.6 trillion of unrealized private equity. Distributions have slowed down. And that's presenting a huge opportunity set, maybe as big as the GFC. If you think about in dollar terms, if you think about 3.6 trillion of unrealized private equity, put that in capital structure terms. Obviously, if you think that they're making contributions of, anywhere from 15 to 30% equity contributions, depending on the industry and company, you can get yourself to enterprise value of companies that's probably in the zip code of 15 trillion. And if you think about that kind of as wrapping your head around, that's more than the sovereign debt of the entire continent of Europe. And so it's a huge opportunity set where perhaps some of those, in the enthusiasm to participate, particularly in the 21 and 22 low interest rate environment before interest rate rises, a lot of those companies were bought at the wrong price. And so what we see is an opportunity set, not necessarily just through straight enforcement or distressed action, but maybe as a capital solutions or a capital opportunities provider where we can help them with effectively trying to grow their business, providing growth capital. And so there's a number of different avenues that can take place. But a lot of it does start, as you correctly said, with the Fed. And I think generally speaking, some of these capital structures that maybe were built for a lower interest rate environment are going to have a harder time existing. And some of the owners of some of these businesses may be stressed themselves with regard to how they're going to make the math work. And I think that all presents an opportunity set for special situations investors.
Yeah, certainly sounds like it in terms of just the need for liquidity. And I would point out as well a great article written by our colleague Jared Gross called The Paradox of Private Credit. If people want to check that out, he was very early to call. I think in 2022, he wrote the first iteration of that article around looking at what higher interest rates might mean for private credit investors and private equity investors. And he's been pretty on the nose about how that's played out. And he's written an update on that article recently. So to close out, I'd like to talk about, we look at a lot of data in the Guide to Alternatives, and one of the data points that struck me is the amount of riskier loans across public and private. If we look at the amount of double or single B, let's say, loans, that represents about 20% of the total market now. That's significantly up from the previous decade. How do you think about this as a distressed investor, this sort of increased potentially riskiness, at least as determined by the rating agencies, of the credit sector?
So some of this is all related to some of our earlier points in the discussion, and maybe starting from an interest rate perspective. I think generally speaking, what we've seen is that sort of in contrast to what you would have thought of historically, as interest rates have come up, you would have thought that would have produced less appetite for credit. I think instead what you've seen is because people were conditioned with low interest rates for a long period of time, we actually saw compression in spread because what you saw was that private equity stopped the deal flow, a lot of slowing in M&A, and the supply-demand imbalance meant that actually people were willing to accept lower spread for transactions. That's been the general trend. We've seen a little bit of a pickup of issuance in the last couple of months, but generally speaking, we've been in a very tight spread environment, and spread is typically the compensation for default risk.
Right.
And if you go back to some of my earlier comments, which is if an asset class that traditionally recovery rates were supposed to be, 60 cents or more, is now in the 30s, the loss given default, which is effectively calculation of saying, okay, if I expect a certain percentage of my portfolio to default, and then I expect to have a loss, i.e. the difference between the amount of money that you lend and the recovery rate, you put those two together, and I would say that generally speaking, the market has been undercompensated for the risk that they've been taking. And so that becomes pervasive across the whole board, which is you see less credit protections. That's the extension of covenant light transactions. You see, as you say, today we're at 4 times what we were going into the GFC with regard to single B credit, i.e. single B credit was roughly around 5% heading into the GFC as a percentage of the market. And if you look at where we are today, as you correctly said, it's about 20%. And so what I think you have is a market that has been conditioned to accept lower compensation for more risk. You see that in the ratings that we're just talking about there. And so to me, that seems that we're in a situation where perhaps there's the possibility that the return profile for a lot of investors is going to be lower when we think about loss given default impact on returns. And that then gets back to what we talked about at the beginning of this conversation, which is the possibility of having a liquidity mismatch where people are going to want their money back. And for us, that's where we get excited and get interested in potentially stepping in, is when you have people who really are not the long-term holders of assets and are willing to accept pretty significant discounts to be able to take advantage of that. And so we're really excited between private equity, some of the excesses that we've seen in fixed income and in private credit generally out there. We're really excited about that opportunity to participate as investors.
Fantastic. Brad, thanks so much for joining me in this discussion. I've learned a lot. I think it's been great for our audience to learn about special situations and distressed debt investing. So thanks for joining us.
And thanks for having me.
That was Brad Demong, Co-Chief Investment Officer of the Global Special Situations Group at JP Morgan Asset Management. To all our viewers and listeners, thank you for listening to the Alternative Realities podcast. You can download our second quarter 2026 Guide to Alternatives on the JP Morgan Asset Management website at jpmorgan.com/GTA. And if you've not already done so, please subscribe to Alternative Realities on your favorite podcasting platform.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed by JP Morgan Asset Management or by other areas of JP Morgan Chase & Company. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions and current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.